thank you very much to all the good people at the FX Street for having invited me to do this series of presentations. Everyone who arranged this, first of all, Francesc himself, who made the contact and invited me, Vicky, Joel, and everyone else who has contributed. I'm hoping to start, like I mentioned, a series of webinars for FX Street. And the first one would be on MACDV, something I've hold very near and dear in my heart. It's Volatility Normalised Momentum. A twice awarded indicator. There will be two parts. The first one, which I will show some core patterns, and the second part of the presentation, which I will show some more advanced patterns. We will keep this for premium members. So let's begin the presentation. First of all, the usual risk warnings that there is a high degree of risk involved in trading, and past results are not indicative of future returns. And I can make one guarantee for you, and that is that you will have losses in trading. Now, that said, this presentation is about a paper I wrote in 2022, MACD Volatility Normalised Momentum. And this paper received 2 awards. The first award was the Charles Dow Award by the CMT Association for outstanding research in technical analysis, and the National Association of Active Investment Managers, the Founders Award for advances in active investment management. So these are the 2 awards I received for this paper. Basically, this indicator, 2 indicators, volatility normalized momentum. And I'm hoping to explain this very briefly in this webinar and also the more advanced version. So let's begin. Now, for those, like I mentioned, there will be attendance bonuses for those that manage to stay awake during this webinar, and also for the premium members as well. So let's begin. Let's put some as a context before the content. So this is what I call the smart strategy system. How one can go from feeling completely scattered to being very systematic. How does one go from point A to point B when they start trading and they receive a lot of information, to how they organize this information and be completely or to very much degree rules-based and systematic. So you have to do, this is the roadmap that we will be following. And the first step you use to follow the macros of the market. That is the Y, and macros represent fundamentals. Then you go into the technicals, into markets, and that's the difference between fundamentals and technicals. Fundamentals tell you the why, macros tell you the when. And then you go into a model, the how you can take this information and take this into a trading plan, a rules-based system, a rules-based methodology. So this is how you go from being scattered to systematic, the smart strategy system, right? So when we look at the macros and the markets and the model, let's see this in very briefly. So the first thing you look at is, as far as macros is concerned, the business cycle. Then you look at commitment of traders report. Then you go into sentiment, seasonality. So as far as technicals is concerned, first we begin with the trend map, look at the trend of the market. Then we go into momentum, and this is what we will be talking about. And basically at this stage, I want to show you the big picture before we go into the minutiae of momentum, volatility, and then we go into relative strength. So this slide is very important because it shows you where momentum is, because I'm sure a lot of people go from webinar to webinar, from YouTube, from articles to books, but it's good to have a big context before you put the content. And then you look at the 4S framework on how to create a strategy, the setup, the signal, the size, and the stop. Setup is why you should be long or short, the reasons for your directional bias, and this can be technical or fundamental. Then the signal, I mean, when do you actually physically get in? The size, I mean, how much you bet per for your position, and then your stops. So the MACDV, this is what we're talking about. It's part of the setups for your technical repertoire. So what is momentum? A very brief introduction. Momentum is basically speed. If we consider the difference between acceleration and velocity, if you look at a car, so how fast a car goes from, if the trend is direction, basically, for example, let's say you live in London and you want to go north in Birmingham, that is uptrend. If you want to go south to Southampton or Portsmouth, that's a downtrend. So direction is a trend. Momentum is the speed. So if you, for example, you go from London north to Birmingham, that would be 60 miles or 70 miles. That's your speed. So if trend is your friend, momentum basically tells you how close of a friend the trend is. How fast is your car going? Is it going 70 miles, 5 miles? And so on and so forth. So what does this matter you? So why is it important that we follow momentum? Because momentum is a very, very good timing tool, because you will be using different entry techniques if the market is going fast and different techniques if the market is going slow. So the first step before identifying, choosing which entry technique you will be using is to identify what the market is doing in terms of speed, because once you've got the speed, then you can have the appropriate timing tools. So as my friend Ralph Acampora, one of the founders of CMT Association said, always listen to MAM. MAM short for momentum. Okay, so let's look at the taxonomy of momentum indicators, which, you know, how can we arrange them. Now, if you go to Tradingview and for a very popular charting platform, and you try to search for the term momentum, you will end up with 125 pages. Now, each page has 18 items. So that basically will give you 2,250 items. So there are a lot of studies for momentum. That's a lot. So how can we organize this? How can we understand, you know, where these differ or not? How can we place them in buckets? So for 2,250 indicators, it means that there are probably more indicators than traders. So basically, momentum indicators fall in two camps. The first one is range-bound indicators. They have an upper and lower limit, usually 0 to 100. It can be 100 to minus 100, but they have a maximum value they can reach and a minimum value. So these oscillators can, for example, be the RSI, the CCI, the stochastic oscillator, %B, %R, and so on and so forth. Or you can have unbound indicators like the MACD, rate of change, and so on and so forth. So all the indicators, momentum indicators, you can see, come in these two categories. They can be literally hundreds of momentum indicators, but they are in these two categories, all of them, range-bound and unbound. Now, I have used both types of indicators, both range-bound and unbound, but I have can't say that I've always been 100% happy with the results. There was always something missing. So let me go into a bit of a detail. Let's go into see range-bound indicators. Let's evaluate them. First of all, the plus and then the minuses. All right, so for range-bound indicators, the advantage they have is that they have normalized scaling. Let's say, for example, in this chart, we see the stochastic indicator. It goes from 0 to 100. So the scaling, since it has been normalized, it is comparable across time and securities. So for example, when the indicator is at 60, 70, or 80, you can go back in time. So for example, you can look at the market of your choice, go 30 years back, 10 years back, apply the indicator, and you will see get the same reading, 0 to 100. Now, you can also apply the indicator across markets. So you can, S&P 500, Euro, one is around 4,000, one is a completely different price market, but the indicator will have 0 to 100 scaling. So that's an advantage it has. But what are the disadvantages that they have? The disadvantage, they cannot expand with the market. And that's due to the 0 to 100 scaling. So for example, look at these cases. Now the S&P 500 in the box on your left went from 3,700 points to almost 4,200. Now, the indicator at the lower panel, which is still the stochastic, could not expand with the market. So it reached a value of almost 100 on the March 16th, when the market was around 3,000, a bit less than 4,000 points. And from 4,000, the market expanded to 4,200. But the indicator still kept its maximum reading from which was around 100. The indicator by its design could not expand more, so you did not have a true meaning of momentum, which means was the indicator to expand along with the market. Same thing happened on the period on the left, so they cannot expand with the market. So as much as the market drives to the upside or to the downside, you will still have the same maximum and minimum values. And that's the first limitation. It's not a true sense of momentum. Now, they also get skewed, for this reason, they get skewed by trend. You get prolonged overbought and oversold readings. So that's the second disadvantage they have. Now, let's look at the second family of indicators, which is the unbound indicators. Right. In this particular example, I've chosen the MACD, the MACD. Now, the advantage it has is that it expands with the market. For example, in this case, as the market was falling, the indicator had a very, very low value. So it was able to adapt with the market. Now, and also the second advantage is it doesn't get skewed by trend. But the problem here is it doesn't have a normalized scaling because it's an absolute price indicator, which basically the formula is, as we will explain a bit in more depth later on. The indicator values are absolute price. They're not normalized. They cannot comparable across from one market to the next, or cannot be compared across time. So this is what you get as a disadvantage of using unbound indicators. So let's look at this a bit more in depth. Look at the MACD. As we all know, a bit of history, the MACD was created by Gerald Appel. Gerald was a fine technician, unfortunately passed away 1 year before I published my paper, because I actually had dedicated to him. So he created the MACD in the 70s, a fine technician, and he was actually awarded by the CMT Association by the 2010 as its annual award. Right, and so let's look at the formula for the indicator. As the top panel is the S&P 500, bottom panel is the MACD. This is how it looks like. I'm sure a lot of people have used it. They say that that the MACD is the most popular technical analysis indicator, I think right after RSI. And this is the formula. The MACD line is basically a short EMA. In this particular case, it's a 12 minus a long EMA, which is the 26. Now, and of course, they also apply a signal line to signal when the momentum changes, which is a 9 non-exponential moving average of the MACD line. And you've got the histogram, which is basically the MACD line minus the signal line. I think that was created by a gentleman called Asprey, just for the history of it. So what are the limitations of the MACD? Here's a chart of the S&P 500 from the late 1950s, since its creation, up until now. And at the bottom we see the S&P, the MACD. As you can see on the left part of the chart, the MACD seems to be making very small oscillations, but almost right after 1996, the oscillation seems to get bigger. Why is that? Look at this. Let's look at it a bit more in depth. So from 1957 to 1971, the maximum value from the MACD was 1.56. The minimum was minus 3.3. From 2019 and onwards, the maximum was 86 and then the minimum was minus 225.4. Now, why was such a huge difference between the indicator values? Because as I mentioned previously, that's one of the problems that the MACD has and all unbound indicators, in the sense that it is an absolute price indicator. It relies on the underlying price. It gets influenced by the underlying price of the market that it is being calculated upon, and it is not normalized. So you cannot compare the value of the MACD today with the value of the MACD 10, 15, or 60 years ago, as you could have done with the RSI. So that's the first limitation that it has. So the second, so basically what we call is not stable across time. It's not normalized. So the second limitation it has is because it's not normalized, is that as you can see on the left part of the chart, when you've got the EURFX futures, a low-priced market, and on the second part of the chart, when you've got the S&P 500, two markets that have completely different prices. So since the MACD is based on the absolute price of the market that it is been calculated upon, that means that the values of the MACD will not be comparable across time. So for example, comparable across securities. And this is how it would look like. So it's not stable across securities, because the MACD, for example, for the S&P 500 might have a value of 60, for euro might have 0.001. That doesn't mean that the S&P has more momentum than euro. It's just that it's an absolute price indicator, so it gets influenced by the absolute price of the underlying market. So it's not, you cannot compare it across securities. So because of these two limitations, you've got a third one, which you cannot create a momentum normalized framework, basically a roadmap to distinguish between high momentum, low momentum, extreme momentum. So for example, like the RSI, you might say, okay, it's considered overbought if it's over 80, or if it's below 20, and so on and so forth. So you cannot create this type of momentum classification ranges. A life cycle model. So the fourth limitation it has is its signal line accuracy. Now, as you mentioned, Gerald Appel, on the MACD line, which is the blue line in this particular chart, applied the moving average on this of the MACD line, which is called the signal line. Now, the signal line accuracy is very low, because it's a if you try to trade based off of the crossovers of the MACD versus the signal line, because it's a trend following model, in effect, you find that it has a very low accuracy. I mean, you don't get many profitable signals. Now, of course, the ones that you do get may last for a long time, and that's a particular characteristics of all trend following models. But you get a low batting average. I mean, you can get anything from 30 to 40% at the best. Usually it's in the 35% range. So, and that's because, the reason is because you cannot filter out signals. You cannot say, oh, I will be taking signals if the MACD does this, it's very low, it's very high. There is no way to quantify low or high. So you have to follow all the signals if you choose to trade this way, and that means that you have very low accuracy. The fifth limitation is because the moving average may lag to signal before the actual trend. So in this particular example, when we had in 1987 the infamous crash, as you can see, when the market, I've noted on a first vertical line on the left, is when the actual market bottomed, and when the right vertical line is when the MACD actually crossed the signal line. Now, the differences between the points was staggering. It was more than 6, 7, 8%. And that means that there was a long time, there was a lag between the actual turning point and the actual turning the crossing the indicator. So the signal was not very timely. And in that case, the signal line timing was not very good. So let's see what happened in 2014. So in 2014, my research started when I was basically what I wanted to do was create a perfect, well, say perfect, I mean a very good indicator, which what would do is take the characteristics of an unbound indicator, the advantages of an unbound indicator, which is that it expands with the market, it doesn't skewed by trend, and also create, have into that the advantage of a normalized indicator, which is basically the RSI, or an RSI type, which is have a normalized scaling. So create an indicator which is the best of two worlds. So first of all, so the idea was take an unbound indicator and try to normalize it. So obviously the first type of normalization you can do is you can take the MACD and then take it into a percentage. So this is how the formula works. Actually, it's called the PPO. I didn't invent this, but it was already invented. So the MACD percentage. So the formula is basically you can take the PPO, the 12 minus 26, and divide it by the, take the short-term EMA minus the long-term EMA, divided by the long-term EMA, and multiply it by 100 to make it as a percentage. Now, let's see how this improvement, the formula, holds up in the market. So the first limitation is does it get hold up across market? Sorry, across time. Again, the same. We'll be examining the exact same issue we have on the S&P 500. Now, from the bottom chart, which is the PPO, as you can see, there seems to be some stability across time. You can see that there is a maximum, there is a minimum. Of course, there are oscillations above and below it, but that's one of the benefits of using the MACD. They can expand with the market. But by and large, it's within a range. So you can see that in the PPO ranges, where so basically through the study, what I'm trying to see is to quantitatively find where 95% of the values resided, and for the PPO, most of the values were between 2 and minus 2%. So when the PPO was above 2%, that means it was overbought. Below minus 2%, it was oversold. So it seems that limitation 1 was solved. The PPO is stable across time. Let's see if it's stable across securities. So on the chart on the left is a fixed income market, the Bund, and the chart on the right is natural gas. So apply the PPO on both markets and try to find if they had the same extreme values. So for the Bund, 95, the closest you can get to 95% of the values was 0.7 and minus 0.7. So above 0.7 it was overbought, below 0.7 it was oversold. But for natural gas, the 95% value threshold was 7% and minus 7%, which means, yes, the indicator normalizes across a security, across time, but it doesn't normalize across a security, which means practically that you have different overbought and oversold levels for each market. So you can see this here on the table we presented here. So for the overbought, for example, the overbought range for natural gas is 7%, for the S&P 500 is 2%, and for the Bund is 0.7%. And that means, yes, the PPO normalizing as a function of percentage can help you in a market, but it doesn't help you across markets, which means practically that if you choose to use the PPO, you'll have to be optimizing it for 100 or even thousands of securities. So that really doesn't solve the problem. And because it doesn't normalize, the PPO is not stable across securities. So since it's not stable across securities, the limitations 3 to 5 remain as the same. So basically, you cannot create a normalized volatility momentum framework to ascertain your momentum when it's high or low, extreme. So the people is an improvement, but it's not a solution. So what happened? Around 2015, 1 year later after I started my quest, I had the eureka moment. I had the eureka moment. Basically, I found the solution. So what happened I asked myself, what was the problem? And this is how I created the MACDV. So the formula, I took the formula for the MACD, and I decided to normalize by volatility. By because my observation was, okay, since normalizing as a percentage by price normalizes the market, normalizes the indicator across time, but it does not normalize it across securities. So my question was, why does that happen? Why? Because a percentage is a percentage at the end of the day. So 2% is 2% across all markets. It should work the same, but it doesn't. And the reason it doesn't work is because the 2% has different meaning for markets like fixed income, which are much slower, than something which is really fast and has a lot of volatility like natural gas. For those that trade these particular markets know exactly what I'm saying. So percentages on the surface may normalize, but in essence they do not because of different volatility. So with that in mind, I said, okay, instead of price, let's normalize by volatility. So I use the average true range. And this is how it looks like the MACDV. This is the indicator with its various values. And like you can see, there is stability across time. Again, I've seen this this is a chart of the S&P 500. It gives you the range of values and how it looks like. I've color coded it to go through the various ranges, which we'll be talking about later. But you can see now on this particular chart, the indicator has a particular range of values that it has. So these are the ranges. Above, when the indicator is above 50, it's trending. Above 150 is overbought. Below minus 50, it's trending to the downside. Below minus 150, it's oversold. Now, there is a lot of math, quantitative work that I did into this particular graph. It's all explained in the paper. I will not go into the details. I'll try to keep this webinar very short and simple. And at the end of the webinar, of course, someone can contact me and I'll give them the paper, and they can go into, if they're interested to see a bit more of the quantitative treatment of how these these ranges came up. So let's look at the 7 ranges that the MACDV has. First of all, so the black line is the MACDV, and the blue dashed line is the signal line. So what I will do is I will show you 7 patterns that will help you highlight and define in a quantitative method, in a quantitative fashion, a rules-based fashion, what the market is doing. The 7 types of patterns that you can have. So the first pattern is what I call the risk pattern. What is risk? Risk is basically what I've called either to the upside or to the downside, what we sometimes commonly refer to as overbought and oversold. So this is the risk range, the risk pattern. So what is the risk pattern? It helps you truly indicate when a market is oversold. And I say truly because the stochastic oscillator or the RSI will get pegged at low levels as the market expands. The MACDV will not do that. So in this particular example, the S&P 500, as it was falling, when the MACDV reached below 150, which is the risk level to the downside, the oversold level, you knew that the market was approaching some kind of bottom. So the MACDV below minus 150 and below the signal line is an oversold level. So that's the first, what we call the range rules, the first risk range. So if you want to identify markets that are oversold, this is your first scan. Now, all the rules are open code. I've placed them in the paper. Of course, I've designed a lot more advanced patterns, but which with the help of FX Street, I will present at the second webinar 2 weeks from now. But all these rules can be quantified. And of course, they can be created into scans, and it can be quite useful. Because as a rules-based trader, what you can do is you can go into your scanners and your screeners and find which markets are rallying, which markets are ranging. You can, in a quantitative fashion, identify these patterns. So the first pattern is what we call the risk range when a market is oversold. What is the second pattern we can look at? The rebounding pattern. As you can probably see, all of the range rules are all 7 patterns, which all begin with the letter R. So the rebounding pattern. What is the rebounding pattern? The rebounding pattern is basically a market that is coming off of a low, sort of like the not necessarily from the risk range, but has had a substantial degree of depreciation in its value, and then started rebounding. So how do we quantitatively define this? So as you can see here from the graph, the black line, the MACDV is above the blue dashed line, which means the indicator value is below above minus 150, and it's going and it's rising. So the rebounding value, the rules are MACDV above minus 150, all the way up until 50, and above the signal line. I have isolated this on the chart, and you can see what the indicator does is exactly what happens on the chart above. So this can be programmed, and I've got the indicators on Tradingview. It's free. And you can say, okay, show me a market that is rebounding, which had a significant fall, and it's going up. Again, rules-based. MACDV above the signal line, and it has a value of above minus 150 and below 50. So these are the two. So you on the bottom panel is the MACDV, and the above panel is price itself. So let's look at the third range, rallying. So after a market has started rebounding, then it starts rallying. So what is rallying? The rallying range. Rallying pattern, the rallying range pattern is when the MACDV is above its signal line, and the MACDV is also above 50. So this is how it looks like. It shows you when the rallying stage. And these 7 core patterns are very important, because depending on which type of market behavior you have, you will need different entry techniques. So when the market is on the rallying range, you need something quick to get you in. You will not have much time for pullbacks. And the second advantage is, of course, one is to pick the appropriate entry rules, and the second advantage is because it's rules-based, like pretty much like everything I do is I try to keep it rules-based. There is not much ambivalence or doubt as to what the market is doing. So ideally, when I show this pattern to everyone, say if we have 100 people and I say, okay, find me a market that is rallying, they won't go into their charts and say, okay, this is this, this looks like it does. No, they will look at based on the MACDV, and they will know the market is rallying. So of course, you will be also taking into consideration the trends and say the market is in an uptrend and now it's rallying, it's in the rallying range. And going from there, you go from identification of the market and the trend and momentum, and then you take it into creating a strategy. So this is the rallying range. So what is the third pattern? And the third pattern is the market, of course, as it begins rallying, it risks risk to the upside, which just means basically overbought. So this is the risk range, again, which is the opposite of the previous risk range we saw on the downside, which again is the MACDV above 150 and above the signal line. So it usually signals stop. Not always, there are rules to the exceptions. Again, I will cover the more advanced rules on the premium membership website. And this is the risk range. So the MACDV is above 150 and the of course it's also above the signal line. As I mentioned before, the indicator is freely available, the rules as well, I've written on the paper, and I would really encourage you to start experimenting with this award-winning indicator. So the MACDV above 150 signal stops. So let's look at what happens when the market starts turning from them. So the next stage is the retracing stage. What is the retracement, the pullback in the market? So how can we define a retracement, a pullback in the market? Many ways. Again, when the MACDV is below its signal line and it is falling and the values it has is below 150 and above minus 50. So this is the retracement range. So this is the so what happens if it has the market continues falling and it goes past the retracement, what we call a reversing range or a raid, a bear raid, as we sometimes call, which means it's gone from a more significant degree of decline. It goes from a retracement to something a bit more serious, like a bear raid. So it's the opposite of basically the rallying pattern. And this is how it looks like. Again, everything is rules-based. Everything I do is rules-based and it's objective. Everyone will take the rules and everyone will follow them the same way. There is no subjective interpretation, at least not as far as this is concerned. So what is the rallying? So this is the reversing range, the raid range. Well, very simple. The MACDV is below the minus 50 and below the between minus 50 and minus 150 and below the signal line. So as you can see in the two highlighted areas, the ranges show you what's going in the market. So as long as you've got MACDV on your chart, you know exactly what the market is doing. You can describe it and then more consciously make an entry or an exit choice. And of course, if you program that as a screener, you can start your trading day in a very rules-based, using rules-based and say, okay, show me the markets that are rallying, show me the markets that are reversing and in a raid, show them the markets that are ranging, and so on and so forth, and create strategies upon it. So the last range upon the core patterns is what I call the ranging, when the market is ranging, the ranging range. So what happens when the MACDV is between 50 and minus 50, which is it's oscillating for some time there. For you can use any kind of filter to see how long it takes. Usually I use 20 to 30 bars. Then you can see there is some trading range in the market, and this is how it looks like. So you can affect trading ranges. The same thing would happen with the histogram. The histogram. Also the volatility normalized histogram. When the histogram is above 40, there is a certain spike. When there is a below 40, again, short-term overbought and short-term oversold. But there is, due to this award-winning work, there was a ripple effect. And the ripple effect was that other popular indicators were also able to be Volatility Normalized. The first one was the LBR 310 oscillator by Linda Raschke. And you can also, did also some work on volatility normalizing that as well. And for that, I would like to thank you for your attention. And attendance bonuses. So the MACDV indicators are free on TradingView. They're on StockCharts. Soon they will be on Metastock and MT4 Optima. A lot of trading platforms expressed an interest to be holding these. So there are free indicators. If anyone would like the have the awarded paper, they can email me directly, and I can send them a link to that. Because it goes into a lot more depth than what we talked about here. Just wanted to keep it very brief as an introduction. And for FX Street Premium members, 2 weeks from now, I will be holding another webinar with more advanced patterns. The patterns I showed are very effective, but again, if you can feel free to use them. For FX Street Premium members, I will show you the more advanced patterns. Again, they will be free. They can be you can code this very easily. And I will hope to see you in 2 weeks' time. Feel free to email me in the meantime. And if there are any questions, please do send them right now. If there is any. Right, Chris to everyone says where to get this indicator in TradingView. Right, okay. What's the name of the indicator? First of all, to Chris, the indicator is called MACDV, V for Volatility Normalized Indicator, V for Volatility. I didn't want to, I could have used my name, but I just prefer to keep the original indicator. I will be posting the MACDV, again, freely available in probably 1 week from now. So Ainsley, I missed the webinar. How do I watch it again? I think you'll better speak to FX Street staff on this. I think it's hoping it was recorded. If not, perhaps we can do it again. Any other questions? Let me scroll up, Chris, to get the indicator in front of you. Yes, again, mention, email me and I will get you on the announcement list so you can get the indicator on TradingView, which like I mentioned will be free. All right, perfect. If extreme members, you can watch the later the recording here. Okay, fantastic. Let me scroll up on the chat box. Very good. I reached the same conclusion. I mixed MACD with ATR already. Nice presentation. Thanks. Nice presentation. All right. Thanks. Yes, FX Street, please. So I hope you want advanced level concept. Yep, Sagar says I want advanced level concept. Yes, most certainly. Again, it will be for FX Street Premium members. There are more advanced patterns. What I would suggest is you experiment with MACDV for the next couple of weeks and tell me how that is. And then I don't have amount. I would assume you probably say I don't have account. Well, I think there's a Black Friday deal here at FX Street. Perhaps you can subscribe to it. And then we can also discuss this or maybe hold some kind of a webinar. Does the indicator offer divergent signals? Yes. Right, good question. Lots of questions. Right, let me see. Can you also have it for an eToro member? I'm not quite sure what platform they're using for eToro, but we can contact me for that to see if we can do that. Jean-Luc, does the indicator for divergent signals? Yes, I've created an even more advanced version of it, which is excellent for a pattern recognition because it isolates highs and lows. So yeah, the answer is yes. Not this particular version of the MACD, the MACDV, yes, but it does. Please the MACD chart again, see form, I'm not quite sure what this means. From Gol, Joel, please the MAC chart again, see form. I think you probably want me to show you the MACD chart if this is what you want me to do. This is how it looks like. I invested 100 now, blah, blah. Right, yeah, sorry Sagar to hear that. One of the, again, we can talk about a different, you can put this as a different webinar. how to test before you invest, which means how to use demo accounts and how to practice, because there is a huge difference between information and implementation. As far as I'm concerned, the ratio, of course, information, what I've shown you is information, but implementation is a lot more, would say important, but certainly you should be spending a lot more time on it. So using Pareto's principle, if someone had 100 days to learn trading, I would say I would spend the first 20 days to give them the theory, the information, and then 80 days for the implementation. So implementation is very important in a supervised way, which means like have someone to provide you feedback, see what you're doing, like a mentor, if you will, or coach, and then start practicing. So with that, I'm not sure how much time we have. I was told that we have 45 minutes. I think we've gone 3 minutes over it. It was a very nice, I think a very nice webinar. The first time I did for FX Street. I hope that I will have a lot more. Again, feel free to email me for more information or to give you the links for the Tradingview indicators and also the paper. And I will hope to see you again in 2 weeks' time. If there are no more questions, I would like to thank each and every one of you. And take care and see you in 2 weeks' time. And again, feel free to, I'll leave you my, this is my contact details. Feel free to send me email, and I hope to see you again in 2 weeks' time. Thank you all very much.